Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Drew, Meredith, how you going?
Pretty good. Good to be here as always.
Yes, mate, it is.
It's a sunny Melbourne day.
Yes, indeed. The next episode is here today, and great to be back. We did have a bit of a...
shouldn't we?
Yeah, it's so beautiful. Maybe we could do one on location soon.
I think you said we
should actually do that.
On a beach or in a jungle.
I reckon we could, like the jungle special, and focus on jungle-related stocks or whatever. There was a public service announcement that came through. I think it was on Twitter, not on the Rask community page. But Mark H in the community did put out, and he did say that the best piece of advice he's ever received on a finance podcast was from Drew Meredith, Everything Eggs Master Foods.
Really?
But then, yeah, it's legit. Look, I'll even prove it to you. For those that are watching, I'll share my
family.
screen.
Yeah, I stole another family secret and shared it publicly.
There you go. Everything Eggs. Look, best advice ever received on a finance podcast. But then there was another one that came through.
It's sold out, isn't it?
Yeah. You were worried about this. You said, if I bring this out on the
sold out
investment podcast. Giles said, the secret Meredith family recipe, not so secret anymore. It was sold out, everything eggs.
Oh, God. I'm going to get all the blame for this too.
SF2230 said, I tried everything eggs and it was not for me. Preferred Charlotte. Savagery.
Absolutely. Well, you got to like garlic if you like everything eggs, don't you?
Well, yeah, I guess you do. But that was...
How many episodes have we done? We've probably done 100 episodes of great investment financial ideas, and the best thing that's come out was...
Well, it makes sense to me. Give the people what they want. There was also a question that came through from... I did see... It wasn't Huck Tour ETF. It was... where was it? Busted wrote in and said, is there a conspiracy in the Rask ranks? If I'm mistaken, Kate Campbell is either a famous swimmer or an obstetrician or both, and the heiress to the Campbell soup fortune. And based on Drew Meredith's turtlenecks and food-related comments, I suspect his family is the one behind the brand of goat's cheese. My favourite brand of goat's cheese. Can you confirm or deny? Drew?
I wish. So it was a Meredith music festival. No, I'm not that Meredith, unfortunately. And there are a lot. So it's surprising. And no relation.
No relation to the goat's cheese. Okay. Well, there you go. Today, mate, we do have some
credit to you for doing the research.
Well, no worries. Yeah. There's a lot of good investigative stuff going on in the Rask community. People following up on your recommendations at their local Woolworths and so on and so forth. People do actually tune in, which is fascinating still to this day. Anyway, mate, I've got some news because it is report season. Domino's, people...
I actually saw some of the biggest news actually came from outside reporting season.
What was that?
Shocking. Incredibly shocking.
Go for it.
Term deposit rates were cut last week.
Yes, they were.
I think I put this into our shared note app that
I checked it going
for some reason. But there was news that the CBA, ANZ, I think the National Bank had all started cutting term deposit rates, and pretty much every term up to 5 years had been cut. I'm not saying by which amounts, but it started at as much as 0.8% or 80 basis points, as some finance people say, and quite a few at 50 basis points.
Well, that's really relevant to your retirement audience as well.
Yeah, it's massive. And there's a question that people have whenever they come in, which is why don't they just put everything into term deposit? When term deposit rates are like 5%, but when they drop to, I'm guessing, 4.2 overnight, it kind of shows you the risk of only investing for income or term deposits.
Oh, for sure.
But it was...
Well, we do this savings account episode on the Australian Finance podcast every now and again.
And they're all...
It's crazy. It's crazy the amount of feedback that we get on people. Like, I'm as someone who has a mortgage, I always use an offset account. I don't use the savings account or term deposit. Now, if you don't have a mortgage or if you're a retiree, then it makes complete sense to use like a term deposit or savings account. But we noticed, even in 1 month, the rate on the ING term deposit of 1 year went from like 5.1 to, I think it's probably 5% now.
And that's the same as all those high yield cash accounts. They're all variable rate, so they look fantastic while the rates are. But as soon as there's a risk of rates falling or rates cutting, they pass it on to deposit holders straight away.
And that's the thing. People think it's the official rate, right? But it's not the official rate; it's the expected rate.
Yeah, it moves before. You think probably loan interest rates move more in line or around when rate cuts and rate hikes happen, but term deposit rates, they're the biggest source of funding, or one of the biggest for probably the Commonwealth Bank in particular. And this is part of, essentially, I don't want to be out there, bashing banks, but it's a way to protect profits and protect their interest margin. If you're paying less on the deposits and you're getting more on your mortgages, and then we just saw a period of basically flat profits from all of them, large profits, but still flat. And everyone that invested in wants growth.
Yeah, there's people at the banks. I believe they're called like the red button team, and they actually just sit there with their finger on the button, ready to cut term deposit rates. But then, like the actual so that happens
like
instantly. And they're looking for any type of trust me, they're looking for any excuse to hit that button and drop the rates. But when it comes to your mortgage, they'll wait a few days after the announcement is made before cutting the rate or something like this. It's that you heard it here first. I guess that's the message. What else is making news in the land of Andrew Derrimouth / Drew Meredith and retirement? Drew, what is making?
I mean, that kind of flowed into Westpac's profit result too, didn't it? Which was early this week. And there was a lot of talk about
Westpac. Who would own Westpac, honestly? But
anyone that owns an index fund owns a pretty big chunk in Westpac. I think it's about 6% in index funds. Anyone that owns a super fund owns a Westpac. But it is the only bank we don't hold at the moment. We've always kind of equally weighted between three, and then things like Macquarie and other bank or financial companies. But it's kind of like CBA streets ahead and everyone else playing catch up or growing. But NAB growing faster. One quarter you'll have Westpac, you'll have ANZ, and ANZ having bought Suncorp. That's changed the system and competitive environment again too. I think it was. None of the share prices moved all that much on the back. I think dividends were fairly above.
I mean, what's the difference, right? Like between the banks,
you got a brand.
Yeah, but are they all just fungible? You know what I'm saying?
And how quickly they can make loans. That was the difference in the last 3 years. The quicker you make loans, the better.
True. ANZ really struggled, right?
ANZ struggled. NAB went streets ahead, and Westpac was kind of around the mark. I think second or third, and the CBA was just pumping it out, and they got a significantly better brand. But it's not. It's a tough business, isn't it? Your net interest margin is 1.8%.
Yeah, you're not making a lot of scratch.
Not great. But then the big headline number, and that's what we all talked about, is 1.8 billion in profit for the quarter. That's a nice big profit. I think it was negative on the previous year, but on a quarterly average, it was 6% higher than the last, I think, 4 or 6 quarters. Most people saw a solid result, and I think apart from CBA, there was no real massive jump in dividends across the sector.
But they're even pushing towards the top of their target range for payout of profits as dividends. But I guess that's the recipe for Australian banks has been for 10 or 15 years has been at increased leverage because your margins are going to fall because this system has become more competitive. So, yeah, sure, exactly. The absolute number of profit has gone up, but the actual profitability has gone down.
I remember looking at net interest margins back in the day, and they were in the 2s. Like I say, back in the day, I shouldn't say that very often.
Yeah. How long ago?
Back in like pre-GFC or even after the GFC. And net interest margins were as high as like 2.5% from memory. That's when you could pump out profits, but your loan book was nowhere near as big. Yeah. I thought one of the interesting things, 2 other kind of interesting things would be, I was listening to another podcast, our friends over in the US.
Animal Spirits.
Great animal, might have been the Compound, but one of the two. But one of the biggest interesting things was in the S&P 500 last year, only 30% of companies that make up the index actually outperform the index.
30%?
Yeah.
Okay. Why did you find that interesting? So 30% did better than the average index?
Yeah. So it shows you that stock picking can be incredibly difficult, or it's all about finding those limited number of winners that have done better. Or probably more importantly, that it's important to have both the market return and, depending on when you're investing, having some level of diversification into active management, whether that's an active manager or you trying to pick out the eyes of the market yourself. So it's kind of saying that there's no single solution. If you just have the index, if you just try and pick stocks, maybe it's equal weight is the outcome as well. But that so few companies actually outperform the S&P 500. And we kind of know that from what the Mag 7's done in the last 12, 18 months as well. But it did go
I will insert a little bit of uncertainty. I'm actually surprised that it was 30%. Because typically stock markets is even fewer companies than 30%. Typically can be in single-digit number of companies that outperform, which is quite interesting. So I don't know. Does that make you worried about investing in the US market?
No, it just makes me cognizant. And then we actually did with Atchison, we did a bit of an investment committee update, and it was super interesting. They plotted every global equity manager on the alpha generated, and as a similar stat that and we kind of know this, that only 30% of managers outperformed in most years, and it was the same in the last year, and they're all kind of it was very tilted towards underperforming and significantly underperforming. But so much of it just comes down to one or two companies in the last 12 months that if you didn't hold NVIDIA at least an index level at 8 or 9%, then you underperformed and you didn't have a chance. So maybe that's just a unique environment, or maybe it's something we have to get used to.
I feel like that it's actually something that people should just get used to, is like winners, the big winners, like the way market cap indexes are made, right, is by that very construction. They have the biggest companies as the biggest proportion. So if those companies go up, of course, everything else will lag. So I wouldn't be too worried about that, but I just worry about, like you said, there's basically two ways to play it. You either think you can pick better stocks than what's in the top 10 of every market, or you can buy that market as well as try and do some other things
as your base level, which is core satellite, which is a question we get all the time. Core satellite is you're buying that market, you're getting the average, and then you're trying to do a bit better by finding some pockets outside of that.
Yeah,
I've got a question for you.
No, I've got a question for you before we move on from this point. Just in share prices alone, so this is straight from Google Finance, obviously the single source of truth for all good financial data. I say that in jest. Over the last 12 months to this very minute, Drew, maybe with 20-minute delay, I don't know how this works, but exactly 12 months ago till today, just share price of these two ETFs. You've got the S&P 500 ETF, IVV, or the NDQ ETF from BetaShares. Which one's done better? To this very moment. If you said that 2 days ago, you would be correct, but you are incorrect, sir. It is 23.5% for the NDQ ETF and 21.3% for IVV. Because this is quite interesting, because for the last 5 years, the Nasdaq 100 has done way better than S&P 500. So everyone's just naturally just used that as their ETF for the US. But there was a fleeting moment when things started to get shaky over the past month, when the S&P 500 started to win. And that's because, to your point, it's more diversified than just the big tech stocks, basically.
I got a question for you. Which major index outperformed in the month of July? Was it the ACWI or the All Country World Index, so the MSCI Global Equity Index, one that's I think covered by VGS from memory, was very similar to, or the S&P 500?
Oh, probably ACWI.
Yep. There we go. That's like I think there's a similar story to Nasdaq and S&P.
You predicted S&P.
Did I?
I don't know. Last month when we debated VGS versus IVV.
I think so many predictions, it's hard to keep up sometimes.
Yeah, it's hard to keep up.
But it's kind of this story that the US share market has always been streets ahead of overseas. And it's only 1 month, and I think the outperformance is only like 1%.
Yeah, what are you doing cherry picking some data from 1 month?
Chart grind.
Yeah, that's massive.
Love a chart grind. That's why I don't have the charts to back it up, because it's just too obvious when you put on a chart. It's like when you have when the outperformance is 0.1%, but you have it on a scale of like 0.0001. That looks
massive chart crime. Okay, so explosive allegations. Go on.
We've got this seems to be like a lightning rod of financial advice, and whether it's advice or investing, Are you a yes or a no to holding gold in a portfolio of any type, of accumulation, retirement, whatever it happens to be?
Like now or just in
Gold
general?
bullion. At now, in general, not as on a price thing at the moment, but gold as an investment.
All right, I'm going to follow this up with another question to you and say, we don't hold gold at the moment inside Rask Invest, but we have held it historically, and I would hold it in an inflationary environment when rates are low.
Like now.
So, no. So I would, like a few years ago, you would have done it because you get nothing on your bonds.
Yeah.
And in fact, there would be probably negative total returns because if the way it sets is that if inflation is high and interest rates are low, they have to increase interest rates to stifle inflation, which means that the bond portfolios drop. So then you're better off not holding bonds. You're better off holding an alternative asset that's not correlated to inflation. So therefore, you may take a gold position as a hedge. So that's when we used it. We don't hold it now. This is contrary to popular opinion, I think, in finance. I don't actually think that gold should be part of a core portfolio. I think that's the question. I think it should be part of a tactical portfolio with a 1 to 3 year view, and that's it. That's my personal opinion. What about you?
Hedged or unhedged? I mean, what's done better this year than Nasdaq or gold?
I always go unhedged. Well, you just go on FY, like January. You go on calendar year now.
Yeah, January to now.
I'd say gold is
it's nearly a tie. Gold's up 21% and still at all-time highs, US $2,500, and that I think that puts it over 3,000 Aussie, and that's in a high interest rate and high inflation environment, and probably low growth, which is incredibly it's not the traditional
usual
period in which you'd expect gold to be working. I think from a portfolio perspective, there's always the thing that how do you price it? It's a precious metal. It doesn't provide any income. Probably the last one, that if it's an advisor or a client, it's always it doesn't provide any income. And not saying it's going to perform like it always has, but when you're retiring or when you try to build a passive income or a portfolio that's growing and producing income, you want things that are going to react differently at different points of the cycle. And half your portfolio is probably not doing well if you're not in tech or financials, but gold is. So it's just something real. Does feel really non-correlated, which is incredible. Yeah. I see it in every portfolio. Basically, it sits into every portfolio we put together.
So how much do you put in gold? Like typical, say, Joe Bloggs rocks up, 65 years old, knocks on the Waddle partner's door, sees you in your badminton outfit, and is like, I like you. Give me financial advice. He rocks in. He's got a moderate risk profile. You build him a 50-50 portfolio. Bloggs' portfolio is ready to go. How much does it have in gold?
It depends. I mean, in your case, if you're doing it tactically and you're really trying to use it as that hedge, you probably need 5 to 10% of your portfolio in it. And that's not if it's a true hedge, but that's if it's a year-only hedge. We build, with Atchison, we build an alternatives allocation, and that's split between either 7 or 8 holdings. So it ends up being one of 7 or 8 holdings within that alternatives, and that goes alongside things like credit or private markets, and it's kind of the liquid alternative to each of those. I think alternative allocations will depend on the objectives of each person, but you're looking at 10 to 15% of a portfolio, and then 12.5% of that, if my maths are right.
So you're saying 1/8?
Yeah,
1/8 of 10 to 15%. Is that correct? Is that what you said? Okay.
As a base level.
So 15, so 1/8 of 12%. You're looking at about 1.2% allocation
in a highly diversified portfolio. Yes, depends. Yeah, and that can obviously swing.
Okay. Yeah. Then if you had to go hedged or unhedged, what would you go with? Gold.
I generally policy would be unhedged. You go.
No. Yeah. That's what I was going to say. Unhedged. Why would you choose an unhedged gold position?
So basically gold performance is based on 2 things. One's on the price of gold and the production of gold and the demand for gold, and one's based on currency. So most commodities are issued in US dollars or traded in US dollars. So if the US dollar is rallying and you're owning gold in Aussie dollars, your Aussie dollar gold is worth significantly more. The difference is $2,500 to 3,100 at the moment, and the performance of each has been significantly better for Australian investors. The question becomes like hedging any other part of your portfolio. If the Aussie dollar's, tracking lower and falls like 40 to 50 cents, then it becomes a question: do you hedge your S&P 500? Do you hedge your gold? Becomes very. I think it fits in the same bucket as thinking about hedging equities. But we'll
go on.
There's quite a few options available now. There weren't for a while, but there were only one or two, and they were synthetic and not, true underlying. We always suggest getting them, not synthetic ETFs, which means they don't hold the actual commodity underneath. They trade futures usually. And I think the big benefit is
continue. Are you stalling?
I'm stalling.
He needs a doctor. Call him.
I think it's just a directional thing, and I think you now have the ability to say, the currency's fallen from 80 cents to 65 cents, and I'm worried it might go up. Rather than selling all your gold, you now have the ability to go buy a hedge version if you still think gold will play a role and remain non-correlated from markets. So our tendency for most things is unhedged because it's very difficult to time these things. But when it becomes obvious, and it's usually we talk about 2 or 3 standard deviations from the average, which we're getting close to at the moment, that's the time we start looking at hedging and putting a hedging policy in place. Because you don't want your returns, like we saw in the 2000s, your returns from overseas equities disappeared because the Aussie dollar rallied.
Yeah, that's true. That's a good point. Yeah. It's a good point.
That wasn't me pausing, that was me losing my train of thought.
For direct investors, you've got like the QAU from BetaShares, full disclosure sponsor of our podcasts. BetaShares has the QAU ETF, which is a hedged product, and the predominant unhedged product is from GlobalX, also a sponsor of the show, with the GOLD ETF. But they do have a new ETF from GlobalX called GXLD. Well, that's the ticker symbol. And the difference is the actual legal structure that the gold is held in rather than a company. It's more of a modern ETF trust. So GXLD, for all intents and purposes, unhedged. QAU for investors hedged. We have a bias towards unhedged simply because there's actually something that happens to a lot of the reason that people would hold gold is for protection, for a hedge against uncertainty. And typically what you see and what you want in a moment of uncertainty, like the GFC, COVID crash, all these instances, is you want US dollar exposure because the greenback is still the reserves currency, as much as the libertarians want us to use Bitcoin. Reality is that USD, big USDs is where you want to be.
Always.
So you're better off having US dollar exposure from Australia in gold. So that's why I think that's still the thing. We did have some. Oh no, the other question I was going to ask you just quickly, Drew. If you're such a bull on alternative assets, Mr. Alternative, do you hold any Bitcoin? And have you had clients come in and ask about Bitcoin?
We have quite a few clients coming in. I do not hold. I've tried to open various accounts at different times just to see what everyone.
But there's an ETF for that, Drew.
Yeah, but you can't get it on all platforms in all superannuation funds at the moment. No, most of my investing is done through super, which I think.
What about for clients? What about if Blogsy came in and he's like, "Hey, you in the badminton outfit, give me some BTC in my portfolio."
So the first thing we do is make sure they're treating it like an alternative, like you treat. I don't really compare it to gold, but like you treat venture capital or something that's truly alternative and highly volatile. So it's make sure they're treating it that way, which means make sure their position sizing within their portfolio is reasonable or is appropriate. So many times you come in, people have done well or they got caught up in it and they've got 40% of their portfolio sitting in crypto of different types. And that just for us, for people who have a certain objective, there's no certainty in markets, but there's even less certainty in crypto, and there's more volatility, it's more directional, it's more momentum. So adjusting that to make sure their portfolio more suits their goals more. And then we don't help, and I think we don't really have an ability to help with things like wallets and opening trading accounts. So if clients are incredibly interested and set on it, we'll find the most appropriate, safe way to do it. And safe being structure, not being safe as in picking currency. And that's using something like it's the GlobalX CBOE listed.
That was the first. VanEck come out
using the ETFs as they come out. Yeah. And being very clear on what you're getting with those. There were some, I think, issues with some of the US ones too, weren't there? The company structure meant they were trading below par value, but that doesn't happen with an ETF.
Yeah, we had the Honourable Andrew Page come on the show last week. Obviously, we didn't get into the Bitcoin thing because we probably would have been there for another 4 hours. But yeah, that's going to be interesting. We're going to have a debate on our podcast and probably on the live show in a few weeks. We're going to have shares v property v crypto. I've already put it to Pete Wargin. He'll be pro property. Andrew can be pro crypto, and I'll just hold my water with the shares. So watch out for that on the Rask YouTube channel. But that's interesting. Yeah, there's a lot of ETFs that have come to market in the US and Australia with these record-breaking launches of crypto or mostly Bitcoin related. Let's separate the two. And there seems to be a growing chorus that Bitcoin is not going anywhere. So should it be part of a portfolio? I say no diggity in my portfolio, but you could do whatever you want, really. You're your own big person, and you can choose to buy Bitcoin if you want in your own portfolio. Well, Drew, we should probably get to some of these questions.
I think you had a comment about, did you make $1 billion this week?
$1 billion?
Someone made close to $1 billion this week, didn't they?
Oh, yeah, Richard. Yeah, Big Richard. Over at WiseTech. So Richard, the founder of WiseTech Global ASX WTC, share price soars on 12% on strong FY24 results, says Jazz Harrison over on Rask Media. She goes on to report, and WiseTech, by the way, is WiseTech creates the logistics software that's used by ports and shipping companies and just general logistics world. And they have this software called CargoWise One. And the beautiful thing about CargoWise is it integrates different customs, port, different types of parcels and packaging and all those types of things you need to do to get. So the hockey, what's it called? The little thing that you hit with the badminton bat, the cock,
shuttlecock.
Drew, that's the one. If you wanted to get a specialist one from say the UK and out here, it'd probably come via CargoWise One, right? So I just want to bring that up as a good example. And you're probably wondering why I keep referring to badminton, because Drew said we can't record on Friday because I'm going to badminton. And it turns out he's the reigning champ in the Waddle Partners office, I believe.
Somewhat, yep.
Okay.
I mean, I didn't win the final, but the final was a bit rigged. The people playing play every week.
Okay, right.
Yeah.
So you didn't win, but that's okay. We'll move on.
Beat all other comers.
Okay, back to WiseTech. And Richard, who is the founder, obviously has appeared on this show before. Total revenue increased 28% to $1.04 billion. EBITDA up 28% to $495 million. Net profit on an underlying basis, yucky, up 15%. Statutory net profit up 24%. Free cash flow, Drew, you'll like this one, up 14% to $333 million.
Humping out the cash.
If my quick math serves me correct, they did a free cash flow margin of approximately 33%.
That's massive.
That's huge. Huge.
Is it a SaaS business?
Well, I remember when I was looking at PayPal in its heyday, and that was doing 24%. So this is impressive. Final dividend up 10% to 0.092. You probably wouldn't buy it for dividends, Drew, because
dividend.
Let's just have a quick Googleizer on this. Yes. I mean, pretty generous dividend of 0.14% of the yield. So, I mean, you're not retiring on that, are you?
1.4, it's 0.1.
0.14.
You've done your maths there, right? Yep, all right.
Well, I'll just confirm with Google Finance, which is the holy grail of...
How much dividend is that?
0.14%. Well, Richard, who owns a lot of it... Yeah, there you go. AFR article 20 hours ago. WiseTech boss $1.7 billion richer after shares rocket profit. So imagine being in a situation where you look down in your brokerage account, you log into ComSec or whatever garbage you use, and you look down and you're like, check, and you're just like, wow.
Sheila. What is this name, Sheila?
Done it. But anyway, classic. That's pretty good. Good for you.
I don't think he didn't get that many digits in a brokerage account.
That's just the game.
I don't think the system.
I remember when old mate Twiggy got like a $2 billion dividend or something.
Dividend.
Wow. You want to check your...
Do you reckon your bank is calling you, see if they can provide, see if they can give you a term deposit?
CBA's like, listen, you've sent this cash here, we need to do something. And then obviously it's been a while since we caught up, Drew, but obviously Pro Medicus, greatest stock on earth.
Zip did okay too, didn't it?
Did it? What's Zip up to? I don't check in with Zip because it's kind of like outside my purview. We sent today, so there's 1.7 billion gone from your net wealth. It's been a good year for Zip. It's been a good year for you, Drew.
Mark up 2.7 billion there. Sure.
How did Zip get back to $2.7 billion? What does it even do? Anyway, Zip is up
240% this year.
500% in 12 months. You were on the money. I mean, it's down like a lot since the heyday when you were saying it's the next Afterpay, but...
I don't think I ever said that.
Oh, no, that was someone else. Never mind.
Breville
up 7% on strong result, says Jazz. Revenue up 3.5% to 1.5 billion. Breville's the company that sells probably the best coffee making machine, maybe La Marzocca, if you're really into that sort of thing.
DeLonghi's not bad.
DeLonghi's good for the automated service. I've got that.
Not sponsored.
I think, DeLonghi, what are you doing? Honestly, DeLonghi, Marzocca, if you're listening, send us some. But anyway, I think my DeLonghi's a bit long in the tooth, to be honest. It's pumped out about 6 or 10 espresso shots for the last 10 years. Anyway, back to Breville. Net profit up 7.5% to 118 million. Dividends per share up 8.2% to 33 cents. Now, obviously, one of the big things for Breville is their overseas expansion. A lot of people don't know this, but Breville is a big business overseas. Breville Group CEO Jim Clayton said, overall, the strength of our new product launches, the expansion of markets, and the continuing coffee tailwind supported this top-line growth as cost of living pressure mean reversion weighed on the business. Pardon me. It's quite interesting. Would you make more... Would it be fair to say that coffee is counter-cyclical, like at-home coffee? Because I'm paying like $7 for a takeaway large soy cappuccino. You know what I'm saying?
Maybe your order doesn't help, but
it's got a twist of
soybean and
honey and
chocolate
and a bit of turmeric on the top. No, but
I'd say 100%.
Yeah, it's pretty expensive.
You reckon more? Like, it does depend on how good you need. You need quality coffee as well, because you get used to quality coffee when you're buying it out, so you need to buy it and bring it home. But yeah, you make the same amount of coffees at home regardless. Maybe you're less likely to get that new bag when you're running out, or you may downgrade a little bit when you get the new bag. But coffee machines, and particularly now, if you're paying $7.70, I think I've seen a lot of TikToks or reels that talk about lean into
go on it.
That just calculate, how many cups of coffee do you save by buying the coffee machine? Even though in my instance, I'd probably just drink more coffee at home and drink more out and not save any money at all. But if you're worried about, if you're trying to cut that $7.70 every day or twice a day, then how many cups of coffee is that? $700 for a machine. 100 cups of coffee, 2 a day, 50 days. That's pretty quick.
Well, I mean, let's get.
You're going to go through a lot of soy milk.
That's the thing. There's we're not just talking like straight up
just black coffee like our t-shirts.
Margin. We're going to talk about margin, not just the old your sales. But yeah, I mean, Breville, quite an interesting business, and for many years, people have constantly doubted how can you compete, against global businesses in the appliance space, selling a hardware product. We've seen this story before; it doesn't end well. But Breville has continuously shown that it can do that. And if I'm not mistaken, Drew, Breville is significantly owned by Premier Investments from memory. Off the top of my head, I could be mistaken. But I think there's a shareholding there. I also think that Premier Investments, which is the owner of Smiggle, Just Jeans, and a bunch of other brands, also has a big stake in Maya, if I'm not mistaken too.
Premier Investments owns 28%
of Breville. Yeah. So a lot of investors who own Premier probably see the Breville it's a better way to play the Breville business is to hold Premier, because you get more diversification across many different types of things. You obviously get a bit of retail, but that's quite an interesting thing. I probably wouldn't be buying Myer. I've never been a buyer of Myer. The whole department store thing with big lease sales is pretty gross. Is it?
Yeah, pretty good sales last week.
Okay. Okay, good to know. That's
Afterpay day, not zip day.
Not zip. People be like, what's zip? You mean like the thing on my shirt? So, okay. What else? So we'll forget the questions, because we do have a few which we should get to, mate. They're bloody brilliant questions.
I thought maybe we'd do
what else
on A-REITs next week. There was a lot of
A-REITs.
A lot of A-REITs reported. I thought we could do, because that ties into interest rates. Probably have another RBA meeting coming up after that, and there's still.
Did you say you probably have another RBA meeting?
Yep. Yeah, I don't put it in my calendar. I just forget the day before and have to turn up and wing it.
Yeah. For a long running
2-day meeting, just biscuits and sparkling water, and that's it.
Long running sufferers of the Australian Investors Podcast, you will know that Drew is actually vying for the chairperson. Let's be honest, of the RBA. So good nice thing.
I think there's a story of reporting season. It's just that there was big corrections or like big shifts if you underperformed. And a lot of them, I think, came from retail. We saw a heap of write-offs or reduction in value in the property sector, and that'll continue to flow through. And we'll see that in pension funds. We'll probably talk about that next week too. But things like A2 Milk got smashed on outlook, not necessarily on their performance last year.
Not to be punny, but like a lot of these companies are a bit fruffy. You know what I'm saying?
Yeah.
Like,
well, I've been watching Ted Lasso, so I love a pun.
This is your second lap around Ted Lasso, but there's not that many. Like, when you think of super high quality businesses in Australia, they're not comparable to some of the names that you would have overseas. So, like, you look at WiseTech or Pro Medicus, astronomical price earnings ratios. They would be great businesses in the US. Don't get me wrong, but in comparison to Nvidia, in comparison to Trade Desk, in comparison to Cloudflare, like, they're in a kind of different realm. So
exactly.
So
multinationals.
So they have different valuations for those types of businesses. And I think when you have a higher valuation of an Australian company that does show any sign of weakness, it's going to be more volatile.
Yeah.
Anyway,
complete.
What did you say about Rip Curl?
Gas bagging all the time. So they had a reasonable turnaround to start the financial year. So it's been a difficult, I think, trading period for a lot of retailers. I think luxury has done okay. Department stores have struggled. They've also cut a lot of costs and tried to come off a low base. And then the likes of Rip Curl and Kathmandu, the KMD brands, had a difficult last year. Sales fell 11%, started to recover. KMD brands.
Oh, is it no longer?
Oh, I thought it was.
I thought it got bought out.
It's listed.
Oh, yeah, okay.
Sorry.
Yep. Never mind.
Research.
Formally
we're well all over that stuff. But there's another story. I think all the headlines come on the retail and consumer-facing companies, don't they? And that's because most of our economy is 67% consumer-driven. So you can get an idea of what's happening in the economy by what's happening in retail stocks.
Yeah.
So it was more that there was a very difficult year, but it started to turn the corner earlier this financial year. Sales fell 11, and I think they're starting to be on the improve.
Yep. So your outlook, if interest rates continue to, let's say, the view on interest rates continue to moderate, is that a bullish stance for you? Do you all of a sudden now go on the offensive? Do you put more of your money, like, do you start to think maybe less bonds, more stocks? Or do you think, like, how do you adjust a portfolio?
I think I wouldn't be making much move for a while, to be honest. Like, even if it starts, it's going to take quite a while to flow through into the economy. And it doesn't seem, I mean, it never seems like something really bad is going to happen. It's going to require a big rate cut. It seems like we're going to get unemployment coming up like in the US, then you'll have to cut rates a little bit, and then usually something happens and it needs to be cut heavily. But I think it's still way too soon and hard to, it's still, they used to say 2-speed economy. I reckon it's like an 8-speed economy. like a
That's classic advisor talk.
Like a Prado.
Advisor talk. That's classic economist talk. So like you're really like, don't forget about, the doctor over here. You know what I'm saying? Like,
because you can be people are doing incredible. It's true though, isn't it? Like every sector and every part of every sector it's not like everyone's doing badly at the same time and then everyone's doing well at the same time, which can happen, in true recoveries. But it's like, it's almost just down to execution at the moment. How is your company executing better than the next one, or how's your business?
Yeah, be mindful of companies with lots of debt and that sort of thing. Interestingly, Temple and Webster has been a bit of like when I think of companies on the nose in terms of like where do you sit in terms of like your leverage to the cycle. Like some companies are more sensitive to changes in economic conditions. I always think of Temple and Webster as one of those businesses that probably would be more sensitive to it. But I mean, the share price bounced in the past week. Shares are up from like a low in 2023 of $3. They're $11 now. So the business overall has performed pretty well. And those types of businesses may be leveraged to a return in consumer spending. Obviously, we've seen household spending rates way down, but these businesses could be back in the game in no time. So probably watch this position. I don't have any deliberate retail exposure myself. It's not the type of business that I own, but quite interesting. Anything else before we get to questions, my friend?
I think that's it. I think we've wasted enough of our listeners' time.
Yeah, they've got the hanging after everything. But we've just been
I'm going to prep for this A-REIT deep dive. I reckon that'll be fun.
All right, A-REIT.
Send us your
I'll
A-REIT
come
questions.
with all the. Yeah, okay. Send the questions in. Obviously, anyone would love to hear from you. Please just send us a question. The funnier, the better. Like Busted before, who was on a food conspiracy. Send us your questions. There's a link in the show notes that says ask a question. Drew, quick shout out. The Australian Retirement Podcast, we've got some questions about it. Drew and his co-host recorded the first three episodes
yesterday.
Yep. So watch this space. The Australian Retirement Podcast. It is available in Spotify and YouTube and Apple, and I'll put a link in the show notes to that so you can go and subscribe. And you'll be the first to know when episodes start dropping. It'll be in the next 2 or 3 weeks, once our editing team has had a good look at it and removed a lot of the swearing. Yeah, it's very sensible, unlike this one. So,
Father, replacing dad jokes with retirement jokes.
Retirement. For anyone that's into that sort of a thing, you can head over there. Father writes in, and this is not my father, but who knows? Could be. Gents, you can call me a gent. Thoughts on education bonds for a long-term investor? They say they are quite young. No, they're saying for someone who is in their 20s. Obviously, you've talked about how education bonds can be quite high in fees, but it's also kind of like a missed super fund because these bonds are taxed differently, Drew. They have like a different tax structure. So a lot of people are looking at them now. If you have the ability to contribute to the bond consistently, you can also take advantage. And you know the 10-year rule. So for people that are unfamiliar, as long as you can contribute a certain amount to this thing called a bond, and within that bond, it pays its own tax and it invests in things on your behalf, effectively. But after 10 years, there's something called the 10-year rule. And after that period, there's a big tax advantage. So the question just generally, Drew, is like, if you're a younger person, not in their 20s per se, but just got probably more than a decade, let's say, to invest, do they make sense? What do you think?
I think education. I assume it's a 23-year-old buying an education bond versus someone buying an education bond for a 23-year-old. I mean, the key with education bonds, they have to be used for education at the end to get the true tax benefit. But more broadly, investment bonds, they are tax-paid entities, so you are paying tax along the way. Generally, they only become relevant where you have it's because the tax rate's essentially the company tax rate at 29, never 100% sure, it keeps changing. Because you're essentially paying the company tax rate. If your marginal tax rate or your average tax rate is below that, then they're not overly beneficial. And in the case that you're in the top marginal tax rate, you'd probably look at something that has less fees and gives you more flexibility first, like a trust. And then if you've got the ability to stream that income to a partner or someone else, if you don't, then these become more attractive. But it tends to be, in our experience, and I know there's many other uses, and we talk to like futurity and generation life quite regularly. that they tend to be, we've got a little banner of the question coming up. This is great too. They tend to be suited to people with higher income. There's so many other ways you can control your tax rather than just putting it into this structure. But good for certain situations in our view.
Yeah, so they're good in certain situations. So let's just be very clear about what we're talking about. This is like you said, a tax-paid entity. So you put your money in, it pays the tax on your behalf, but you effectively have a claim to it. The longer you use one of these things, in particular after the 10-year rule, so 10 years, there becomes significant tax benefits. And in this instance, they're asking about like a subset of the overall investment bond universe. They're asking about education bonds. And these have a particular legalistic, definition around them, which means that you can only use their money from that for educational expenses. And there are rules and T's and C's you should look at before you get involved with any of these. But generally speaking, there are these broader things called investment bonds. And these are the same tax structure, except at the end, you get to use the proceeds on different things like, I don't know, whatever, like passive income, you can reinvest it, you can do all these types of things. The key thing is that you don't stuff up with the rules because it can trigger things and you can lose all of the benefits effectively.
Exactly.
I found in a lot of my work, Drew, that they're best for people with high incomes because the company tax rate is, like you said, let's say around about 30% minus the franking credit benefits. You're looking in the high 20s.
Yeah.
If you do that, and so if you use one of them, and just say you're a famous economist that works for the RBA, and you pay tax at 45%, it might actually make sense for someone in that situation.
Yeah.
But rules, T's and C's, check them. Okay,
and a good way to pass wealth to the next generation too.
Very good way. Yeah. So Haktua ETF writes in and says, ETFs trading at a discount? I like how everyone refers to us as gents. It's almost like we're gentlemen. Hi, gents.
Dudes. I prefer dudes, maybe.
Maybe, but then it becomes too broy. So, gents, I'll take. Hi, gents. I'm fairly new to using ETFs as a product in my portfolio. Interesting language. From what I thought I understood regarding ETFs, they should trade close to the value of the assets inside them, as opposed to a listed investment company, which swings in roundabouts. I'm just making this up as I go along, but that's the general gist. After the recent sell-off in the Nasdaq in early August, particularly seeing daily drops of 3.5% on the US stock market, even the Magnificent 7 down 4 to 9% individually, how does ETFs like NDQ or the FANG ETF then trade up 3 to 5% the next day in Australia? Is it consumer confidence, opportunistic dip buying here in Australia, or currency related? It just makes me wonder, from what I thought most ETF providers are spruiking, that their product should always trade at close to the NTA or the tangible asset value. Can this also work in the opposite direction then? That it can trade at a discount if more sellers than buyers in a decent downturn? Thanks. Let me simplify this question for people.
You're going to put this question on the ribbon?
No, I will not, because it's a very long question. But basically, the general gist is, if you wake up really early in the morning, let's say you're on West Coast time, and you're waking up real early, and you're like, I trade US stocks, and you're up at 3 a.m. And then you see the US stock market falling in early August. And then when the Australian stock market opens, you're like, hey, hold on a second. All my US stocks were down, but my NDQ ETF is somehow trading up. How does that work? So like, how does an ETF that's here in Australia that should be following the US market go up when the stock market in the US just closed and it looks like it was down? That's the general gist, Drew. How is that even possible?
Well, the nature of ETFs is that they won't ever trade away from their net tangible asset value, that there are market makers and there's enough liquidity. You will see some, depending on how big they are, you will see some gaps at different points. But the reason they perform or outperform just comes down to currency and makeup. So
it does.
I think a 4% swing and a 4% gain is unlikely and very rare. I'm not sure if that's when that's happened, because that means there's 8% in currency. You're never going to see that much change in currency. But to see like a 1% loss become a 0.5% gain, they're completely understandable, because if the Australian dollar falls heavy enough, that's why something like that would occur.
Yeah.
That's it.
Preaching gospel, mate.
But basically, you've got these professional investors that are jumping in the background, and if that ETF trades away from its tangible asset value, well, they're going to buy all the stocks and make one together and sell that, or they're going to break it apart and sell the stocks for what they're worth.
Mm-hmm.
Yep, essentially.
So what happens? I'll provide a slightly different explanation for what can happen here behind the scenes. Technically, the way an Australian ETF is created that invests in US markets or any global market. If you think about it, if Drew and I here, we're trying to trade zip shares up and down and it's 11 a.m. in Australia, that means it's probably 6 p.m. somewhere. Someone's having a beer somewhere, right? That means that stock market's probably closed. But if that person that's also having a beer in Positano wants to trade zip, they're trading outside of hours, right? So the same would happen with an ETF provider over in Europe or in the United States that has an Australia ETF. Like, how do they do that through time zones? They use something called an indicative INAV, which is INAV. What it basically means is they estimate what the market would be trading at. What we've seen around the world is that over the last, say, 10 years, in particular, more like the last 5 years, is that a lot of stock markets have started effectively creating their own market. And so even though, like here in Australia, the stock market's open from 10 a.m. to 4 p.m. or thereabouts, in the United States, they're also open for a particular window, but then they have aftermarket trading or after hours, they call it. And this is basically a construct of people can still submit buy and sell orders through their brokerage platform, and it doesn't need to necessarily settle via the stock exchange. So they can get an indicative price of what's happening. Now, the case may be, I don't know specifically what this person is referring to, Hakutua, but basically what would likely be happening is by the time the Australian ETF starts trading, the after-hours market in the US have realized that they've made a mistake, and that's started to go up. And
there's that after-hours trading. Yeah. That's something we forget about too. So you'll always see a lot of companies reporting in the US at like 4:10 immediately as the market closed, and they're running in the day, and then they'll have aftermarket trading and they'll be up 15%. But then when they open the next day, they'll only be up 5%.
Exactly. Yeah. So I'm going to try and share my screen for anyone that can see on YouTube right now. But if you just type into Google, say like you type in NVIDIA stock symbol, seeing that it's the thing that everyone seems to want to talk about in this day and age, you can see that yesterday NVIDIA ended up 0.98% in the positive. So it was a positive 1% movement. But right below that, it's got after hours trading 0%. But you can see on the chart in Google Finance, you can see that it's continued to trade after 4 p.m. So at 4 p.m. it closed at $128.50, but investors kept submitting orders even till now, up until 7:59 p.m. is what the current time is in the United States. And so ETF providers and these types of organizations have been doing this for years. And so it's not unusual that even though the stocks in the US might have fallen, the after hours trading might have gone up. And that can be reflected in the ETFs in Australia. So that's effectively how they operate. And I know that sounds like a lot of gobbledygook to folks, but basically, if you think about it, if you're buying an ETF here in Australia, the people that run that ETF in the US are probably, having samosas or just chilling out on the couch at the time you're trading. So there has to be a mechanism for that. And that explains that anomaly. We went into the weeds there. Next question, winner's curse. I don't actually know anything about this ETF, so Drew, maybe you can talk to this one. Does the VanEck Global Listed Private ETF, ASX GPEQ, get you exposure to private equity investments, or is it the performance of a basket of private equity companies? ? In your portfolio construction, could this ETF give you a private equity risk return exposure? We see a lot of these types of ETFs, Drew, that come out and they basically put something in the title, crypto or private equity, credit, AI. And then people then pop the hood and they're like, hold on a second. I thought I was getting baked beans, but I'm getting something else, getting spaghetti. What's going on here?
Huevos one of those chetos.
Is this one of those instances or is this something else?
I mean, it's exactly as the questioner says. It's basically a bucket of private equity companies. As the name suggests, private equity, they're private market assets and they're not easily accessible. If most people investing in private equity, you got to lock away your money for 5 to 7 years, and it's not available to the masses. So this is like a second derivative, and albeit generally a reasonable way to access the returns coming from private equity. So what the ETF providers, what the private equity companies would say is invest in the parent company, because if we do well in our portfolio, we're going to get more performance fees and you're going to get better returns. You're going to get higher profits. So because private equity is so difficult to access, most of the time you need an advisor. Most of the time it has large minimum investments. Because of that, things like these become somewhat of I've lost the word that I want to use for that. An alternative, but I don't want to say, I mean, there's an alternative asset, but it becomes an alternative to that type of, alternative for the king of alternatives. And it's not perfect. Like you'll see listed private equity, as the name suggests, it trades like a listed entity because you're investing in listed entities. So it's not going to get the correlation or the lower volatility benefits that you get from investing into unlisted private equity, but it does give you an exposure to the sector.
Okay.
But definitely falls within the growth alternatives with equity-like characteristics.
So private equity, most people's understanding of what that means is kind of like private companies that you buy part of. But because you can't do that in an ETF, you're saying that this ETF doesn't, because it can't actually go around to the local shop front and buy part of my favorite toasty joint or your favorite fish and chip joint. What they do instead is it just invests in the companies that do that investing, or the funds that do that investing.
Yeah, so the top holdings, like La Trobe is owned by Blackstone, a massive private equity firm, from memory. Blackstone is the second biggest holding in this. Everyone's heard of KKR. I'm not sure whether they did who did the Virgin, or Bain Capital did the Virgin deal. You're talking about the Carlyle Group, all the biggest, largest private equity firms in the world, and you're investing in the headline company. And sometimes they have listed entities, like a listed investment company, that have some other investments in it, and they would potentially be included in here. But predominantly, they're all the largest management companies that extract all the fees from the deals, essentially. This has formed part of the Atchison models, because there's some restrictions about what you can invest into on certain platforms. This becomes an alternative that's more accessible and liquid to get that exposure if you think it's there.
Okay, so for ETF investors, they could consider something like this. We don't hold something like this. Maybe we could in the future if we wanted to open this up, but we tend to be purists at Rask HQ. This is quite interesting. I noticed there's a private equity company called Hercules Capital, followed by Mendel. Yeah. Anyway, we've got time for one more question, Drew. Is there anyone in particular?
Apologies for rambling on early.
We will answer many more questions next. But, what do you want? Is there anyone that you want to answer? I can go.
Happy for you to pick. There's quite a few kind of detailed ones here too. So
yeah, really detailed. Okay, so I might go with, as just a way to wrap us up for today, and we'll answer more questions next week. Thank you, ladies and gents. The questioner name for this one is Drew's Views, brackets, possibly new segment name, and yes, I'd love a book, please. This is a great pump for Drew's book. What's it called again?
The Golden Years.
Golden Years.
So, how to cook the best eggs in retirement.
How to cook the best eggs. Master Food is endorsing this. So the question goes on to say in their question, hi, really appreciate the show and get a lot out of it. So thank you. Well, I'm glad. In reviewing asset allocation, we are wondering how to think about macro. Do we consider the aggregate of both super and non-super assets? So when they're thinking about how much stocks, how much bonds, how much cash, how much private equity or whatever, do they include the super and the non-super assets, Drew? And secondly, do you think about asset allocation for a couple based on total combined assets? For example, if one member of the couple has a conservative super portfolio with some capital guaranteed investments plus defined benefits,
would it be reasonable for the other party to be much more aggressive to balance the things out, or high growth, I would say? So basically, Drew, this is a question of like, if you're thinking about long-term positioning of people's wealth, so not just their portfolio, but their wealth, do you take a super plus non-super investments equals things that you're going to look at and balance? Does that make sense?
Yeah, and I think this is like the perfect question for the retirement podcast that we'll be launching shortly. We might take it over there and answer it there as well, and get James, so you get two views, because we often disagree with each other, just like me and Owen do. I mean, the first question of this is how do you both feel about risk? So if you do you invest? Do you view, some people view their assets as being separate. If you view assets as pooled and you both view risk in a similar way, like you're both comfortable with some equity risk, and that's probably the compliance part of this question. Like if one person isn't comfortable with equities, the other person is, or loves risk, then it's kind of hard to say you should blend it. But our default would basically be, you've got a total pool of assets. Your aim is to generate a passive income from those assets that both of you are sharing, and 100%. So I'd say most of the time, if you've got a defined benefit and it's government guaranteed or guaranteed in some way, that gives you the ability to be holding a more growth-oriented portfolio elsewhere. And then what we tend to say is, and I'm not sure if a lot of advisors have the ability to do it, that we don't necessarily think about product, but we think about total wealth. Essentially, once we've got the asset allocation right, we'll look at where is the best entity to hold each of the assets that we're recommending, or each of the asset class we're recommending. So naturally, if you've got defined benefit or fixed interest that are lower returning and you're in a taxable environment, you probably want those outside of super. And if you've got high growth assets, they're going to be capital gains, they're going to be ETFs that distribute all their gains out of your control every year. You want them in a lower taxing entity like super. So is it possible to build a consolidated portfolio that gives consideration to the best entity structure or the best taxable entity for each of those investments? And it's not always possible, but the answer is yes.
Consider it as one big, and also then balance things out accordingly. And that's a pretty common thing. Like a lot of people, present to a financial planner, and they are not just like, yeah, I've got my single stock portfolio with an industry fund, and here it all is nice and clean. There's things that happen, and some of those things that you might have accumulated time are really good, and some of the things that you might have accumulated are mediocre, and some of you, like if you're in a couple, you'll disagree on certain things, and it's how do you balance that? So that's a good question. Drew, people can get in contact with you, get a book from you. We know how to do that. Drew at Wattle Partners. If you got your question on the show, you get a free copy of Drew's book. We also have to pick the best question and name for a free value investor program on Rask Education, usually $499. So the most creative name. I mean, there's a lot of good ones. Basically, everyone that asks a question, you can get a free pass to the value investor program. So just write into us and tell us that you were the person that asked this question, and we will get you that $499 course free of charge. Don't forget, we've got heaps of questions in the pipe already, but we will be back next Saturday, with more questions to be answered. So send in your questions, get them on the show. We'd love to hear from you. And if you do want financial planning advice, the place to head is the link in your show notes. There's a big link that says financial planning there. Click that, and you'll be matched with a financial advisor. If you're in retirement, you got Drew and the team at Wattle Partners here. So, Drew, this has been heaps of fun. Always a pleasure. You've got to give us the dad joke on the way out. And I will remind people.
A little bit risque.
Oh, it's got to be on the edge, otherwise it's not worth doing. But I will remind people that there is a link in the show notes. If you are approaching retirement, over 45, 55, whatever your definition of approaching retirement might be, or in retirement,
passive income,
jump on the Australian Retirement Podcast. Passive income, he says. Just throws that out there. Still the great Dr. DRE here, Drew Meredith / Andrew Derrimouth. Take us off into the sunset with a bit of a joke, mate.
Why do ducks have feathers? To cover their butt quack.
Bang, bang, mate. That is on the edge. And if you do have, you can write into Drew at Wattle Partners with all of your complaints, feedback, and your complaints. But But seriously, we'll be back next week. I'll give you like a 6 out of 10, mate. It wasn't.
That's right. I wasn't sure what word down here, so hopefully I didn't take that one too far.
Not at all. If you do play badminton tomorrow, mate, all the best for that. And good to see you. We'll be back next week.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.